Yes, there was certainly some downward selling, and particular note we saw the materials sector, which was really dragging down on our market today. It was in fact the worst performer. It closed down 1.9%. We did see iron ore prices overnight falling at 2%, down to $100.70, and that's down around 25% since the start of the year. So we really are seeing those iron ore miners coming under pressure, particularly Fortescue, which was down 4.6%, as well as BCI, which closed down around 4.5%. But we also did see BHP and Rio all trading lower today as well. I think all of the Australian iron ore producers are profitable at the current levels, but there are some that are looking risky, and it's really those ones that have those higher break-even costs at around $70 to $80. So the Atlas Iron, Fortescue and BC Iron. The less risky ones, of course, are looking like BHP and Rio. We are forecasting the iron ore price to probably fall to around $90 US a tonne. I know there are some bearish analysts out there expecting it to fall even further to around $80 US a tonne. So really, it's that tight credit over in China and weakness in the property sector that is expected to continue. So we could potentially see some further falls in these iron ore stocks.
Just 7 to buy Fortescue.
I suppose it is looking fairly attractive. I think there probably is still some downside risk to the share price in the short term. As I mentioned, I think the iron ore price is going to continue falling. But in the longer term, as you say, Fortescue does have some strong underlying fundamentals. The no debt situation is also very positive for the company. So it could be looking like a potentially a low level for investors to get in at. But we are potentially seeing some further falls in these iron ore prices.
Scott, I know.
That's right. It was a very strong performance today from Dulux. They reported net profit after tax up 87%, earnings before interest and tax up 59%, and their interim dividend was in fact up 25%. So it was a very strong performance today by Dulux. As you said, it closed up around 0.5%. Our outlook on Dulux, we do still remain fairly positive on it, although it does look like it is trading at fairly expensive levels at the moment. Dulux, we know, is highly leveraged to an improvement in the housing market. But secondly, we also know that one of its biggest customers is Bunnings, and we do expect to continue to see some of those sales trends coming through. And we also know that Bunnings has a plan for its new store rollouts. But thirdly, we also expect a recovery in paint demand and continued earnings per share accretion from the acquisition of the Alesco businesses in 2012. So we do think it is going to continue sustaining its premium rating, but as I mentioned, it is trading at record all-time highs at the moment, so it does look fully valued. Nonetheless, we are forecasting earnings per share growth of around 13% in 2014 and around 12% in 2015.
That's the key for shareholders, isn't it? Because Leanne, they could look at the numbers, they go, look, that looks great, but all that does is go some way to justify some of the creep it's already seen in its share price. You see a lot of the building exposed, construction exposed stocks on or around all-time highs. People, getting in early on the leverage and the turnaround in the construction sector. So you've got to weigh up how much further can it go? I mean, do you think it looks too expensive?
Exactly. As I mentioned, I do think there is going to be potential for further earnings per share growth. It is fully valued. It is looking expensive, but there are all those positives there in place, and we are continuing to see an improvement in building constructions. They have reached record highs at the moment. So there are other stocks in that building space that we do quite like as well. Brickworks is one of them. We do think that's fairly good value at the moment. That's trading at around a 30% discount to its peers. So that could potentially be one to keep an eye on.